Hey guys, Todd here of tradinganalysis.com. This is the free video for Thursday, September 18th, and the Fed was behind us, confused the hell out of most people, and actually confused the markets as well. So I'll take you through the four major asset classes, show you exactly how they responded to the Fed today. I'll show you how they interpret it, and give you the next trade going forward. So before we dive in, we did have a NASDAQ short. We closed that today. We stopped ourselves out. Stocks are very unsure of what's going on here, how to interpret this Fed message of whether it's lower rates for a longer period of time or whether the Fed's ready to start raising rates. So let's dive in, and I'll show you, in fact, that the three asset classes did respond and one didn't. What did respond was bonds, commodities, currencies. Stocks didn't know what to do. And here's the chart to show you that exactly. So here's a 5-minute percent change overlay of the dollar futures, S&P here in white, US 30-year bonds, crude, and gold. So you can see pretty clearly that crude was down most of the day, gold was down, and then when the Fed came out, bam, they really hit the skids as the dollar rallied. Stocks finished almost unchanged on the day. Didn't know what to do with the data. All right, so the big mover today was dollar up and then bonds and commodities down. That's a message from the non-stock market asset classes that the Fed is about to raise rates. Obviously, it wound down bond purchases, and stocks don't know what to do with that. You know, they're on one side they're saying, well, the economy is strong enough for the Fed to begin to tighten up monetary policy and reduce the stimulative policy measures they've taken. But on the other hand, you know, we've been liquidity drunk for years now, and what's going to happen when we don't have that anymore? So it's kind of interesting. So let's dive into two of these asset classes specifically. Let's take a look at the dollar, and let's take a look at bonds. Okay, now this is going to get a little confusing. Here are the 10 and 30-year U.S. bond markets flipped on their heads. It's basically a yield chart. You guys should know this. Bonds go down, yields go up. Okay, so what I did is I flipped the bonds upside down and put them on top of dollar yen. These were your big movers today. Dollar yen broke out hard, and bond markets broke down, yields broke up. Effectively, this is a 24-hour yield chart, and that's the relationship we want to focus on. Okay, guys, this isn't the first time I'm talking about this. I did the free video back here on the site just back on September 9th. Yen breakdown sending major warning signals to bonds. Bonds are much lower from this video. Not all the videos we do send out are right, and you know we're right sometimes, we're wrong sometimes. This Q's trade didn't work, but this bond trade worked in kind of a big way. So, all right, so what do we do with this? We know that bonds are breaking out. We know bonds are breaking down. We know that the dollar is breaking out. So let's focus in on this yen market, and this is what we're going to do to set up the trade. I think bonds are going to continue to go down, which means bond yields up, and what that does is lower bond prices, higher bond yields will press the spot dollar yen market up. There's that strong move here on a daily chart, okay? The yen ETF, the FXY, actually tracks the yen side of that, all right? So the FXY is going to trade inverse to dollar yen, okay, because the yen is on the second side of a dollar yen exchange rate on the way they quote it. So what we can do is just do the same thing we do with bonds, just right click, invert it, boom. Now we're trading yen dollar right here, and we can look at exactly what's going on. Actually, no, this is now dollar yen in the ETF and dollar yen in the spot rate. So how high can this guy go? The FXY, we're going to use dollar yen spot rate. Okay, so we're through the 618 retracement of the decline from the 2007 high. This is all the credit crisis, guys. Okay, and we're just going to do some analysis on the dollar yen spot, and then we'll slide the inverted FXY on top of it to get your levels. So we're through the 618 retracement. Okay, the next level is going to be the high from August 2008, which is just below the 786 retracement. Okay, so we're looking at a level of about 112 to 113 in dollar yen. What is that going to equate to in the FXY? Remember, I took FXY and flipped it on its head, just like this. Inverted, boom, like that. Okay, so we're going to go back, inverted, compare apples to apples, and we're just going to simply look over at the left scale and say, okay, the FXY level is about 86 to about 83. All right, so let's just take those numbers, put it the right side up. So we see the FXY going down as the dollar yen goes up, FXY down to 86 to 83. Okay, so we now have done our technical analysis. You know what the intermarket relationships are. How do you put on a trade? Let's go to the platform. Okay, before we answer that question, let's dive in to implied volatility. And this is very important to understand when you're putting options positions on. Now, here's the FXY, the right side up. I didn't flip it upside down. And here is the implied volatility overlaid on top of the average true range. And what you'll actually find out is a lot of times they're very similar. Okay, so where are we in terms of range and volatility? The big breakdown we've seen here in the yen really is just giving us this push up in implied volatility as well as average true range. If you look at it compared to what's happened, over there on the chart, we've actually come a long way from the recent highs. We've seen much higher ranges and we've seen much higher volatility levels. Okay, look right here. Okay, even back here in February, we've seen levels up around about 0.12, and that's your implied volatility, about 12%. Right now, we're trading at about 8% implied volatility. Okay, so point is, this is not the time to be short volatility. We've seen much higher ranges and much higher volatility even this year, February of this year, going back to the middle of last summer. I mean, we've seen 17%, 15%, 16% volatility. So this is not the time to be short. If this breakdown is for real, and going back to this analysis, that the FXY could head down to like 85, 82, 83. It's actually time to be long premium in the yen, not short premium. So a couple trades that we'll be looking to do with clients are in the FXY. We want to be on the put side. We're going to look out to December. And we closed at about $90. So we're going to look on the put side. Maybe look to do a buy, just a simple buy vertical, buy the 89, or sorry, buy the 90, buy the 85. It's $1.33 credit. So you'd be risking about $1,300 to make $36.70. All right. That's too much, guys. Just simply change your size. It's not a big deal. Go down to 5 if you want. You can risk $665 to make $18.35. And that is going to be probably the trade. We're going to work that out tomorrow. All right, let me just take a look at what those prices are. Option chain, 90 to 85. That's not too bad. Deltas of 50 down to delta 10s. That's pretty good. We'll look to put that trade on. This is a longer term trade that should continue to play out. Basically, it's not the time to be short volatility because, as I said, it still has room to expand, and this market is really breaking down, so we could see more volatility in that yen product. So that'll be the trade, guys. Hope that helps. Hope that makes sense. There's a lot of stuff going on there. We did bonds overlaid with dollar yen. We took dollar yen, overlaid it with the FXY, which is the currency ETF, flipped the FXY upside down to compare apples to apples with FXY and dollar yen, then flipped it back right side up, then did the option, then looked at the volatility and determined that though volatility is rising, it still has room to go, so it's not time to be short. Call credit spreads above. It's probably better to be long put verticals as volatility continues to expand. All right, guys, good luck. Hope that helps. Made sense. It's a crazy market out there, but this is the kind of stuff you got to be trading because remember, stocks don't know what to make of it here. And the bond market and currency markets are the ones that are moving. So you want to get involved there. Also, guys, if this video helped, whether it confused you, whether it didn't confuse you, if it did, whatever, but was interesting, give us a like, give us a subscribe on the YouTube page, and we'll know that you guys are enjoying the videos, and we'll continue to do more, put more good information out. I appreciate the feedback. It's been very nice on the comments. If you have any questions, comments, insults, anything you want, please put them down. I enjoy speaking to traders. I work in my home office here. I'm down in the trading analysis studios, also attached to my house. But nice to hear from you guys out in Traderland. So throw them in there, and we'll talk to you guys soon.